your account is looking mega red like mine, you might be looking for some new opportunities other than buying the dip. And in this video, I'll be discussing some of my preferred option strategies for navigating and profiting in a bear market. Now, these strategies I'll be talking about in this video have the potential to bring in 30 to 100% returns in just a few days if it's set up correctly. So make sure to stick around and see that. And as always, if you find any of the information helpful, please leave a like and subscribe. It means a lot. So first off, the strategies that I'll be talking about today are going to be option spreads. So if this is something you aren't very familiar with, I would recommend you click on the recommended video up top for a refresher. But enough with the fluff, let's get into it. One strategy that can be very profitable in a bear market is the vertical credit call spread. It is a vertical spread because we are buying and selling options at different strikes, but the same expiration date. And it's a credit spread in the sense that we get paid a premium up front for opening a position. And it's a call spread because both of the options would be calls. So again, this strategy or position would be called a vertical call spread. Now, generally speaking, credit call spreads profit on stocks that decrease or move sideways, which makes it a perfect strategy for a bear market. So let's build one out on Webull as an example. If you don't have a Webull account yet, check out my referral links below. We both get some free stocks if you sign up. And Webull is my preferred broker for my Roth IRA. For this example, I'll be using one of my favorite tickers for spreads, which is the SPY ETF. And we can go to the option chain and select the vertical strategy. And we can look through these strikes after picking an expiration date. So let's move down to something quick, like 2 days from now on January 28th. And we can scroll through these strikes. Ideally, with this strategy, you pick a strike at a level you do not think that the stock will go above by the expiration date. And of course, in a bear market, most stocks are going to go down. So that's why it's a lot easier to do this strategy. However, you have to be mindful of your own risk tolerance. Again, this video isn't serving as a technical analysis video, but let's say that we think that the SPY will stay below 440 for the next few days. So we'll select the 440, 441 strikes. Now this next part is very important. We have to make sure that we set this up correctly. And we want it to be a credit call spread, which means we need to be selling to open this position as a whole. And the best way to visualize this is by going to the strategy analysis tab at the top right. And for this specific strategy, it's where it says vertical. Now by default, Webull has set me up for buying this, which is definitely not what we want because a long vertical call spread is bullish and bought to open. So we can toggle from buy to sell, and we can see how the profit loss chart changes. And it shows that we're having a max profit as long as the stock stays below 440, which is what we want. So with this spread, you can see that the max profit is $31 and the max loss is $69. Credit spreads generally have a higher max loss because they have a higher chance of profit. For instance, at this time, this spread has a 7-ish% chance of profiting. And how you determine the chance of profit is a whole different video in itself. So let me know in the comments if that's something you want me to discuss. Now, if you want more profit, we can adjust the strikes or we can adjust the width of the spread to change the premium here. So going with the latter, we can adjust the width from 1 to 2, which will widen the spread. And you can see that it changes the max profit to $59 and a max loss of $141. So again, more profit, but more possible loss. You could also just change the strikes. The more in the money you are, the more max profit you could possibly get, but it will also change your profit chance a lot. So play around with these as needed. And if you want me to do a detailed video on credit call spreads, let me know in the comments. Now, once you're happy with the strikes and the spread width, the whole setup, we can hit done and we can adjust the limit price and how many contracts we want to open. Now, the last thing that I want to say about credit spreads is that you need to have funds in your account to cover the collateral. And for most brokers, anytime you're selling to open a position like this one, you need to provide some form of collateral. But easy enough for us, the collateral for a spread is always calculated as the width of the spread. So for a 440 to 442 spread, that would be a width of 2. And with options, everything is counted in a per share amount. So 2 times 100 would mean you would need to have a collateral of $200 to enter this trade. And Webull or whatever broker you're using will hold these funds in case you're exercised But if the position expires or you close it early, those funds are released back into your account. So to summarize, I have to provide $200 of collateral to open this position, but I will get $59 upfront from selling to open this position. And provided the SPY stays below my short strike, which is 440, I will keep the full $59 and the $200 is released back to me. $59 on a $200 investment is a 30% return on collateral, and this position is only active for 2 days. So 30% return in 2 days sounds pretty good, right? Well, just wait till you hear my second strategy that can give an 100% return in a week. However, this video is going a little longer than I was originally thinking, so I'll cover that second strategy in another video. So make sure to subscribe so you get notified when that video drops.